Awesome, everyone. Let's start our session number 4. So, guys, so far in our basics of derivative, what all I have discussed with you people, I have spoken about what are derivative instruments, how we have different forms of derivative instrument, be it forward contract or future contract or options or swap are different from each other. And we have discussed the history of how different forms of these instruments were gradually got introduced over different underlying beats, commodity or credit or equity or interest rate. We have discussed the phase by phase manner. Also, we have discussed of the history of derivative in India, how it was being implemented in India. So I hope you have understood what is forward contract, you have understood the history of the of how derivative instruments are introduced. Okay, you got to know about LC Gupta committee or Professor J.R. Verma committee. You have to remember the recommendation of Professor LC Gupta committee and Professor J.R. Verma committee. Okay, because Professor LC Gupta committee did the groundwork of should be introduced derivative in Indian market or not, and they recommended that derivative as in security should be introduced in our market. Then Professor J.R. Verma committee worked on the risk management mechanism, or the way the exchange of broker should govern when the derivative should start working, what should be the margin requirement, or how the risk management mechanism should work. All that was discussed by Professor G.R. Verma committee. So you should know the difference between them, the way they have discussed. We have spoken about the products, different products in the derivative market, be it a forward contract or future contract, what are options or swap. I really don't think that you'd have understood much when I have spoken about options. Don't worry on that part. I'll again, further sessions. Again, we're going to spend a lot of time discussing on options. So you don't have to worry on that part. Only thing for the time being, remember that in the case of option, the person who take long position, he or she does not have any obligation. They have right, but no obligation to follow the contract in the future. In order to enjoy that right, but no obligation, they pays an amount to the short position holder, which is their maximum loss, while the maximum profit is unlimited. Talking about a short position holder, the loss are unlimited while the profit are limited to the initial premium what they receive from the long position holder. Now here I will talk about market participants. So broadly, when I talk about the market participant in the derivative market, we have hedger, we have hedgers, we have speculators, we have arbitrator. So what are hedgers? Hedgers are those people who consider derivative market as an instrument through which they can minimize the risk. So the examples of farmer traders, demand supply mismatch, whatever I've given so far, those were the examples of hedgers only. Hedgers are those people who are doing hedging. Hedging is all about risk minimization. So hedgers, talking about hedgers, they face risk associated with the price of underlying asset and use derivative to reduce the risk. I hope you understood. In order to reduce the price risk, or in order to reduce the uncertainty which is being created because of the volatility in the price risk, the set of individuals who take the help of derivative to fix the price on which they will undergo the transaction in the future are called as hedgers. The person who take long position in derivative instruments are called as long hedger, while the person who takes short position in derivative market to hedge their risk are called as short hedgers. So corporation, investing institutions, and bank all use derivative product to hedge or reduce their exposure to market variable such as underlying, such as interest rate, share market price, bond price, currency, and commodity. And then next set of individuals are speculators who take risk, and through taking that risk they want to earn return. Like imagine if you anticipate certain momentum in the market. Okay, like if I give you an example, okay, if I give you an example, like here if I'm seeing the Nifty chart, Okay, I'm recording this video in 18th February 2024. And imagine if I'm observing the Nifty chart here. Okay, so here you can see in 5-minute chart, you can see in negative directional index value, although the trend is getting stronger. Okay, it's somewhere around 22. While if I'm going and checking 15-minute chart, okay, I can see a positive directional index value with the decrease in the trend. So the negativity what you're seeing, that's gonna decrease. Whenever you're seeing a downward ADX value, means it's showing an sideways momentum with biasness toward the positive sign. Okay, and if I go and check the 30-minute chart here, if I'm checking 30-minute chart again, you can see strong build-up in the positive directional index with the increase in ADX. So gradually what this chart is basically telling us that next tomorrow when the market will open, it might open with a gap down with the initial certain minute. Might be there's a possibility that market might fall down, but gradual 30-minute chart and the 15-minute chart are showing a buildup of ADX, although that positive DI is building in all the chart, but ADX was either down or not very much strength. But in the 30-minute chart, you can see a very strong value of ADX that shows that tomorrow when the market will open, or maybe later half of the day, but gradually in the next 3 4 days, you can see a positiveness or bullishness in the market. So imagine once I understood this, what I can do, I can go and take long call, or means I can buy the Nifty index. Okay, you are getting me. I can go and right now you can see the Nifty is trading at 22,040. I can take one out of money call option, maybe 22,100 or 22,200, like that. I can take one strike price, and there I can buy a call option, because gradually I know that within 2 to 3 days the Nifty will definitely will rise. May not it will rise tomorrow till half day, because today is a Sunday. So possibly might be if I go and check 10-minute chart. Okay, there's a no 10-minute chart here. Imagine if I go and check like this kind of momentum if I'm seeing. So possibly I'm expecting that gradually from tomorrow mid session or somewhere before that, there will be an upward momentum in the market. Okay, you will see some form of sideways thing here. You can see some form of sideways thing getting developed here, but this sideways will not exist for long time. You can see there this sideways. If you this sideway whatever you're seeing, this sideway will not exist for long. Okay, if I'm just searching for rectangle, okay, you can even then here this this is not working. Even let it be. So this sideway whatever you're seeing, the sideway what you're seeing here, the sideway will not exist much, because although you are seeing a downward value of ADX in 15-minute chart, so maybe not to maybe not tomorrow, but somewhere tomorrow end of the day, to Tuesday, Wednesday, Thursday, definitely the Nifty will go up. Okay, that definitely I can say by looking at this chart. Okay, everyone. And then maybe gradually again, you can see the positive in 1 day chart. When I'm seeing again, this is getting down, and again the ADX is coming down also. So maybe that will not persist for long, and again the sideways momentum will start. Okay, this is what I can say. So imagine if you're a speculator, what you can do, you can take one out of money call option on this scenario, and you try to take it for 1 day or 2 day, and the moment if you think that it has reached its benchmark threshold value, you can better exit from that position. You're getting me right? So imagine if I open another trading view. Okay, imagine if I open another trading view, and imagine if I click on Nifty here. So what should be your target to come out of that? Let me just show you that part. Let me just cancel the ADX here, because multiple charts are not possible here. You can see this. So if I need to go and just search for auto support and resistance. So auto support and resistance by Sony Perlin. So this will give me basically the resistance value. The moment it when you see the Nifty touching that resistance value, you can possibly exit from the contract. Till that time, you will see a small sideways momentum. Then there would be uptrend, but that will not persist for long time. So I think 22,050 or 22,100 would be strong resistance value that what you can see for the current movement. Anyway, so I believe you have understood what are speculators. Speculators are those individuals who try to predict the future momentum or the future movement in the price of the underlying asset. And based on that, they take position in the market so that they get benefited from that event. Okay, so derivatives are preferred over underlying asset for trading purpose as they offer leverage. And you know that when you take position in the derivative market, you don't have to pay 100% money what you have to pay when you actually buy an underlying asset. But here, by just paying upfront either premium or certain margin value, you can take position on the underlying asset, and gradually by taking exposure over the underlying asset, if the event happened the way we expected, then we end up in making very high profit. But at the same time, if uncertain event happened, then we end up in losing also. That's why there's a concept of lot size whenever we want to trade in the derivative market, because they are less expensive. So we can take more exposure when it comes to hedging with respect to the speculation in the market. Now, good third thing, we have spoken about hedges, we have spoken about speculation. Now, talking about arbitrator, arbitrator are those individuals, okay, who participate in the derivative market, okay, or who take counter position. They always take covered position. They take position in spot market, also in derivative market. Okay, and arbitrage is basically deal that produce profit by exploiting a price difference in a product in two different market. Okay, arbitrage originate when a trader purchase an asset cheaply in one location and simultaneously arrange to sell it at a higher price in other location. I hope you understood. You buy something in one market at some value, and you sell the same thing in another market at a higher value, and thereby the profit what you make is a risk-free profit. Such opportunities are unlikely to persist for the long time. You understand, the moment if any arbitration possibility appears, everyone want to participate in that arbitration and to make the risk-free profit. Such arbitrator would rush into this transaction and thus close the price gap at different location. I hope you understood this thing. Okay, now I'll just switch off my camera and I'll proceed further. 1 minute. Now, going further, if I talk about the different types of derivative market, just hold for a moment. Yeah. So if I go further and talk about the different types of derivative market, you know that whenever you want to trade in the derivative market, either you have heard of exchange based trading or you have heard of over the counter based transactions. Already I have discussed. Okay, initially derivative was there in OTC market only, and gradually from OTC market now we are seeing an exchange based derivative trading. So in the modern world, a huge variety of derivative products are available. They are either traded on organized exchange, which we call them as exchange traded derivative, or they are agreed directly between the contracting counterparties over telephone or through different media platform, which we call as OTC based derivative instrument. A few complex products are constructed on simple building block like forward, future, option, and swap to cater to the specific requirement of the customers. Okay, so you understood these products, either I talk about forward contract or future contract or options or swap. Why they are being created? They are being created because as the time has progressed and the way the complexity in the financial market were increasing to cater these needs, more and more innovations happened in the financial market, and the objective of these instrument was to somehow figure out the necessity of the time. Okay, like how certain instrument can be developed so that it can help certain individual to minimize the risk if he or she is acting as a hedger, or that should help other individual to take more risk and earn more return if they're acting like a speculator, or if someone who's exploiting multiple market at the same time, how they can maximize their gain through that, then they are called as arbitrator. So when I talk about, suppose if I'm talking about OTC market, so over the counter market is not a physical marketplace, but it is a collection of broker dealer scattered throughout the country. When you're talking about OTC market, so certain description of OTC market is given here, where OTC is basically, it's a web enabled integrated market of different dealers who are connected with each other through phones or through any other media, where the main idea of this market is a more a way of doing business than a place where the buying and selling of contract are matched through negotiated bidding process over the network of phone or electronic media that link thousands of intermediaries. So OTC derivative market have witnessed a substantial growth over the past few years, very much contributed by the recent development in information technology. So basically, as such, there's no organized media when you talk about OTC based market, where certain set of individuals in any part of the world, they're connected through any kind of global communication network. Through them, when the bidding happens, through that they decide the price based upon the average bidding and average asking value. The price is being decided. And when you talk about OTC derivative market, they have bank, they have financial institutions, they have sophisticated market participants like hedge fund, corporation, and high net worth individuals. OTC derivative market is less regulated market because there's no capital market regulator like for all the instruments which are trading over NSE and BSE. SEBI is the regulator, and for any kind of instrument where currency is involved, then RBI also come as a regulator. But when you talk about OTC derivative, they're less regulated because these transactions occur in the private among the qualified counterparties who are supposed to be capable enough to take care of themselves. I hope you understood simple English. So in the OTC derivative market, okay, when you talk about OTC derivative market, when you're talking about OTC derivative market, the transaction among the dealing counterparties have certain features compared to the exchange traded derivative. Like when you're talking about OTC market, how they are different from the exchange based market. Contract are tailor made to fit the specific requirement of dealing counterparties. I hope you understood. Means in the case of OTC based instrument, we create a product, okay, those product which is, what you say, what is which is mutually agreed among the two counterparties based upon the mutual convenience. Okay, no third party involved between them to decide the terms of the contract. So they are customized, tailor-made bilateral agreement. When you talk about OTC, the management of counterparty or credit risk is decentralized and located within the individual institution. There are no formal centralized limit on individual position leverage and margining. There are no formal rules or mechanism for risk management to ensure the market stability and integrity for safeguarding the collective interest of the market participant. That transactions are private with little or no disclosure to the entire market. You are understanding that when it comes to OTC based market, we are assuming that the player who are involved in the OTC market, they know the risk getting engaged while when they participate in the market. So based on their understanding of the risk, they are participating in the market, and they know that how they can safeguard themselves from these risks. Okay, and whenever we are talking about the transactions are private with little or no disclosure to the entire market. They don't have to govern any central market regulator rules and responsibilities. Okay, whatever they feel the mechanism should be there for their mutual interest, they can decide that, and based upon that they agree to follow the transaction. Okay, there might be possibility of credit default or counterparty risk, that that is mutually agreed upon. And if any such risk happens, it is they know the risk and reward when they involve in the OTC based transaction. While when we talk about exchange traded contract, they are standardized and they're traded on an organized market, okay, with the interaction between buyer and seller through the enormous auction platform. So when we talk about exchange-based trading market, there the participants they participate without worrying about the counterparty risk. Already I explained a lot about this. So a clearing corporation guarantees the contract performance settlement of the transaction. When I talk about significance of derivative, okay, so derivative it help in improving price discovery based on the actual valuation and expectation. I hope you're understanding. It enables the transfer of various risks from those who are exposed to risk, but they have low risk appetite to the participant with the high risk appetite. For example, hedger want to give away the risk where the trader are willing to take the risk. It enables the shift of speculative trade from unorganized market to the organized market. Risk management mechanism and surveillance of activities of various participants in organized space provide stability to the financial system. So when I talk about the significance of derivative, what derivative is giving us, derivative is bringing those individuals who are ready to take more risk. By taking more risk, they want to earn more return. Okay, so those individuals are speculators. So speculators are ready to take the risk from the hedgers. Hedgers are those individuals who want to minimize the risk. In order to minimize the risk, they are coming to the market and they're trying to give away the risk to certain other individuals who want to take the risk. So derivative is giving or creating a mechanism where players like speculators, hedgers are coming and they're talking about the terms of the contract which will be done in the future, thereby enabling all different participants to interact with each other. Their objective might be different, but again, it create a liquidity, it create a better discovery of price mechanism because in the case of derivative future options and all, we are talking about a transaction which will be done in the future based on the present determined condition. So if you observe the bank Nifty future value, suppose Nifty is right now, if I talk about Nifty, suppose if Nifty is right now trading at 22,040, I can go here and I can check the Nifty future. And when I check the Nifty future, if Nifty future is more than 22,040, that shows that yeah, people are somewhat optimistic on Nifty in future. And by looking at this chart, you can see that if Nifty future resistance is somewhere 22,100, then you can expect that definitely the resistance of the Nifty would be also around 22,100 only, because futures and options transactions, their open interest ultimately guide us to understand what is happening in what will happen in our market. I hope you understood this. Okay, so various risks faced by participants in the derivative market. The risk can be counterparty risk, the risk can be price risk, because of demand and supply, the price will change in the future. And that's why we want to take an exposure in the derivative market, right? Then the risk can be liquidity risk. So when I talk about liquidity risk, like imagine that like when you talk about forward contract and all, you cannot sell the forward contract, right? Imagine you want to give away from the forward contract before the maturity. That is not possible because they are not traded over the exchange. So the swap or forward contract, which are OTC based instrument, they also have this risk of liquidity. Although because of futures and options, somehow we try to minimize this liquidity risk. Then they can have legal or regulatory risk, operational risk. These all are subjective. If you read, you will understand. Okay, a market participant should therefore carefully consider whether such trading is suitable for him or her based on the participant. So because whenever we participate in the derivative market, the understanding of risk management, the ability of risk, what we're taking in the market, that understanding is very important. So and an understanding over the risk disclosure document, it's very important that all the participants should have an idea about the amount of risk he or she is exposing themselves whenever they are participating in the derivative market. Okay, so this much is there to discuss in the first chapter. Going further, if I see the sample question, what is the index option? It's not a derivative, it's not a debt instrument, because index options basically is talking about a derivative instrument where the underlying asset is the index. Index is what? Index is a portfolio of different stocks. Maybe those indexes we created maybe based on the market capitalization or maybe based on the sectors. So basically it is a index option. It is a basically equity based derivative instrument. So here out of the four option, it cannot be money market. Money market is again a short-term debt instrument. So it's not together, it's debt instrument. Neither is a cash market product, it's a derivative market. Then next thing, the purchase and sell of any underlying asset in two different market, that is basically a process of arbitration. Okay, when you talk about financial derivative, it gives you a facility that you can even hedge, you can even speculate, and you can even arbitrage. Okay, so operational risk include losses due to operational risk include losses due to the what do you say the way how we manage the system around ourselves. So if I talk about operational risk, you can see here. Okay, operational risk basically what all factors comes under operational risk. They can be fraud, inadequate documentation, inappropriate execution, and it may not be appropriate avenue for someone of limited resource or limited trading experience or with low tolerance. So operational risk is not about knowledge. Operational risk is not about the way the instrument is trading in the market. Operational risk is all about how much you are aware about the operating that particular instrument. Like you know that at this era we are doing trading over in internet, right? So you have your demat account and your broker is given you an app over which you can buy and sell any underlying asset, any commodity. So the when you take decision, like suppose if you want to do intraday, and while clicking the option in your in your trading app, instead of intraday you clicked on delivery. So what will happen? You will not able to what you say. At the end of the day, imagine if you do not execute it, it will stay there. And or you wanted to take intraday where you wanted to take an advantage of the price risk, but that did not happen because you could not execute the transaction the way it was supposed to execute it. So operational risk is all about when you undergo any operation. Trading is again an operational activity, and when you're performing this operating activities, if you create any error in doing that, that may be system bound, okay, or that may be because of redundancy of the same work. So that issues happen because of operational risk. So operational risk include losses due to government policies. No, government policies and all come under market risk. Income tax regulation, again it will come under market risk. Too much of management control, so it might not be an operational risk. It may be a regulatory risk or something like that. So then there's only one option left called inadequate disaster planning. So you if you could not plan your activity in appropriate way, because when we engage in any form of operations, we need to aware about the step by step mechanism which we need to follow, and what kind of parameters we need to keep in mind while performing in certain activity. If those are not performed in appropriate way, that will create an possibility of operational risk. So guys, this make me to end this session where we have ended the first chapter of discussing on basic derivative instrument. So far in this first chapter, we have discussed the history of derivative. We have spoken about forward contract, future contract, option, swap. We talked about players like hedgers, speculator, arbitrator who are involved in the trading in the market. We discussed about the different forms of risk involved in derivatives, counterparty risk, price risk, operational risk, regulatory risk. We discussed how the derivative was introduced in the Indian market. So I hope it was informative and knowledgeable session for all of you, and you learned a lot from me in this session. whatever I've discussed, if you have any doubt, you can please use the comment option and ask me questions. Otherwise, it's time for me to wind up this session, because since I know that you already have subscribed my channel and you'll definitely will click on the like button. So I'm not going to tell you that framework again, because I know that I'm doing a great job and you people are highly motivated and satisfied because of me. So guys, time that I should wind up this session. Take care. I'll see you all in next session. Bye everyone.